Hey everyone, welcome back to Corporate Decoder, the place where we find out that even companies with fancy names borrow money. This report from Graphic Packaging Holding Company is all about debt, and not the fun kind you sing about. We're diving into a new loan agreement that could reshape how they handle their money for the next few years. Before we get into the nitty-gritty, if you like breaking down complex business news into something easy to understand, make sure you subscribe. And hey, we have a Discord community linked in the description below where we chat about these things too, so come join us. So what exactly is this filing? It is a Form 8K, which is basically a report companies have to file with the government when something significant happens that investors need to know about right away. Think of it as a company's way of saying, hey, PSST, something important just went down. The big event here happened on the 31st of October, 2025. It is not a spooky Halloween trick, but it is a pretty big financial move for Graphic Packaging Holding Company. Graphic Packaging Holding Company, for those who might not know, are the folks behind a lot of the packaging you see for food, beverages, and other consumer goods. They make boxes and containers. Pretty essential stuff, right? Their stock is traded on the New York Stock Exchange under the ticker symbol GPK. The main story in this report is all about a new debt agreement, specifically Graphic Packaging International LLC, which is a subsidiary of the main holding company, has entered into something called an incremental facility amendment. This amendment is to an existing credit agreement, and it adds what is called a delayed draw incremental term facility. Think of it like getting a credit card, but you don't have to use it all at once. They can borrow up to a whopping $400 million. They have a window of time from the 15th of March 2026 to the 15th of April 2026 to actually draw down this money. It is not like a piggy bank where the money's just sitting there waiting. They have to make a move within that specific month. And when do they have to pay it all back? By the 30th of June 2027. That's not a lot of time for such a big loan, a little over a year and a half. This suggests they're planning to repay it fairly quickly. Now, about the cost of this money, it is going to be based on something called SOFR, which is a benchmark interest rate plus an extra percentage. This percentage can range from 1.00% to 1.75%. Basically, the more debt they carry relative to their earnings, the higher the interest rate they'll pay. This is a common way for lenders to manage risk. They also have an option to link the interest rate to the base rate, which is another common benchmark, and that would be plus 0.00% to 0.75%. The company gets to choose which rate they prefer, likely based on which one is cheaper at the time of borrowing and how their financial health looks. Even if they don't use the money, they still have to pay a fee on the amount they could borrow. This fee ranges from 0.10% to 0.25% per year on the unused portion. It's like paying for a reservation at a fancy restaurant you pay to hold the spot, even if you don't show up. And what happens if Graphic Packaging can't pay this money back? Well, they've pledged virtually all of their company's personal property assets as collateral. This is a pretty serious commitment. It means if they default, the lenders can take a good chunk of what the company owns to get their money back. So why are they taking on this new loan? The money from this $400 million borrowing is specifically earmarked to pay off their existing 1.512% senior secured notes that are due in 2026. They are essentially refinancing one debt with another. This section just confirms that this new loan agreement is indeed a direct financial obligation for the company. No off-balance sheet magic here. It is all out in the open, and as usual, they wrap things up by listing the attached documents. The most important one here is Exhibit 10.1, which is the actual incremental facility agreement. That is the full legal document spelling out all the terms and conditions of this new loan. This exhibit is the heart of the filing, outlining the specifics of the deal. Now, looking at this from a bigger picture, Graphic Packaging is using this new loan to replace an older one. The older notes had an interest rate of 1.512% and were due in 2026. This new loan is for a much larger amount, $400 million, and if they draw it all, the interest rate will be significantly higher, potentially between SOFR plus 1.00% and SOFR plus 1.75%, or base rate plus 0.00% to 0.75%. SOFR and base rate are currently in the ballpark of 5% or so, meaning the new rate could be in the 6 to 7% range. This tells us a few things. First, Graphic Packaging is managing its debt, but it's also facing higher borrowing costs. Refinancing a 2026 note with a loan that matures in 2027 might indicate they expect interest rates to come down by then, or they simply need the flexibility of a new credit line with potentially different terms. The large amount suggests they might be anticipating a need for cash for operations, acquisitions, or perhaps to manage significant upcoming expenses. The fact that they are pledging almost all their personal property assets as collateral is a strong signal of their commitment to this new debt, and it highlights the importance of them meeting their repayment obligations for investors. This means keeping a close eye on their leverage ratios and their ability to generate enough cash flow to service this new, potentially higher interest debt. The strategy here seems to be about managing their debt maturity profile and potentially accessing more capital if needed, but it comes at the cost of increased interest expense and secured assets. So, what is the takeaway? Graphic Packaging is actively managing its finances and borrowing more money, but it is paying a higher price for it. This move indicates they are focused on their short to medium term financial stability and operational needs. Alright, that is our breakdown of Graphic Packaging's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think they are making a smart move by refinancing? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. And don't forget to check out the Discord in the description for more discussions. Thanks for watching. See you next time.